Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, July 15th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you personal financial advice. This is for informational purposes only. Any ideas or companies mentioned on this podcast or video are not investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, before we get into the weekly market update, I just wanted to talk about my free weekly email newsletter. It goes out to about 3,000 people a week. It's a weekly email that you'll get. I don't spam people. I don't send you 3 or 4 emails a day like some publishers. I basically just send you an email. It's a short email. It usually is topical to what we've been discussing here on the videos. It may drill down a little bit more deeply into, could be anywhere from, what's going on in the offshore oil market, different opportunities around different themes that we're talking about on this channel. Some people find it useful, and as an incentive for you to subscribe, if you do subscribe, and again, it's free weekly newsletter, I will send you an ebook that where I publish the 10 investing rules of Bob Farrell. Bob Farrell is a 50-year veteran of the markets, is a technical analyst, and he has some pretty insightful rules that he generated over his 50 years. And one of them is, for example, which we'll be talking about during this particular video in some cases, or in some of the slides, is that excesses in one direction will lead to an opposite excess in the other direction. Markets that overshoot on the upside will also overshoot on the downside, kind of like a pendulum. The further it swings to one side, the further it rebounds to the other side. This is one of the main themes of Actionable Intelligence Alert, the newsletter. We look for situations where they've been bombed out, blown up, forgotten. No one cares about it. No one's talking about it. And then we look and see, is there some potential for a change? One of the things we're talking about is that we've become interested in, for example, is Argentina. And I explained in the newsletter last month why I think there's potential there for a trade, at least up until the end of the year or in the next couple few months, which also could lead to a multi-year bull market there. Again, the place is a basket case. You would say it's very bad. You could use a lot of language to describe the economy there and the market there, but the thing only needs to go. It's another example of a situation that could very well go from bad to less bad. And as I've shown many times before, and this is some of the things that I talk about, like in the weekly free email, are situations that are setting up to go from very bad to less bad. And when that happens, for example, in uranium, offshore oil drillers, Cyprus, certain different things that we catalog in the newsletter, that can result in multi-100% revaluations. Not always, it doesn't always work out, but you'd be surprised how often it does. So again, if you're interested in the weekly emails, like I said, there are a few thousand people get it already. Some people find it useful, and the subscription, it's again free, and it'll come directly to your inbox. So just wanted to mention that. And like I said, the incentive is, I'll send you a free ebook that kind of gets into more in depth into these 10 rules that Bob Farrell came up with. They're very fascinating, and you'll be shocked that in the ebook, I took the rules and then showed various examples throughout history that confirmed, these rules, or demonstrated these rules. So it's a short ebook, and some people have found it useful. Okay, let's get into the weekly slides. So I found this interesting. Again, this came from a tweet from that car lot guy or whatever, car guy. I've always been following this as an indicator of, I've mentioned cars, car loans, people with car notes of $1,000, 25%, I think 20 to 25% of the car notes now are $1,000 or more a month. This is showing used car prices falling. I think they were down 4.2% last month. This is the second largest decline in history. And you can see, I mean, forget that this is the used vehicle value index. If this was just like a stock chart that I put in front of you, would you be more inclined to buy this chart or sell it? I think I would be selling this chart. It looks like you had a basing, you broke out, you had this meaty, huge move upwards, and now it's failing. And then after its first decline, it tried to rebound, and now it's failing again. So I would be a seller. And so that indicates to me that I think that in the economy, I think people's purchasing power is starting to constrict. The excess liquidity, I think that's one of the things that us so-called recession bros have kind of didn't have a handle on, which is how much actual money was actually out there sloshing around. I mean, it's trillions of dollars. And so I don't think anybody could have known like how long that would last. But we're starting to see anecdotal evidence such as this, that, people's ability to spend like they were is, I think, beginning to wane. So we'll keep an eye on this. I find it fascinating. This also is one of the, it's not a major component, but it's a pretty decent component in the CPI. I think used car prices and new car prices together are around 8 to 10% of the CPI. So it does have some effect there too. But definitely would be looking to see with credit, contracting, with rates a lot higher, with manufacturing in recession. Again, as long as employment continues to hold in, I just looked at before I got on here to do the video, the weekly initial claims, they're really kind of right in that 250 to 275,000, 280,000 range week to week. Continuing claims have kind of leveled out around 1.75 million. So we're not seeing that push for unemployment. One thing I did see was a Luke Gromen tweet, which I'm going to investigate further, showing that the amount of people that have went on disability, Social Security disability, SSI, I guess it's called, from 2020 to now has risen by 5 million people. So if we've taken 5 million people out of the workforce, this is something that has to be considered around employment. I haven't had enough time to deep dive it. I just saw the tweet and saw the chart was off of the St. Louis Fed website. Like I said before, if you want to know anything about any kind of economic detail that's being tracked or counted by the Fed banks, I mean, the St. Louis Fed has everything you could think of. So I'm gonna go back and take a look at that. But like I said, if we have 5 million people out of the last 3 years on disability, I'm not going to get into why that is. I think you know why that probably happened, but we won't get into that right now. But if that's the case, then we could have we could have a built-in labor shortage. So it's something worth looking at, is what I'm saying. Because, like I said, the last pillar of the whole HOPE framework is employment, and as long as employment continues to hold in, then, like I said, if you give $100 to the average person, they're going to spend it. They're not going to save it or invest it. So consumer spending can hold in as long as employment and wage gains hold in. So anyway, moving on. Rent deflation, we're also seeing. This is just off from apartmentlist.com. You can see during the pandemic, things spiked, as you can see, but since they peaked in 2022, basically, things have been in decline. We're actually below zero. So we're in a deflationary tendency for rents, right? So that's another thing that's going to slowly but surely eat away at, the CPI. So just like to post these things. I'm not, going to get into a deep dive on CPI or what the Fed looks at. we're starting to see it though, right? We're seeing, different components. We've seen inflation after it peaked at what, 9-something%. It's been coming down. So the point being that at least listening to central banks and what they're going to do going forward around rates and liquidity, these things all feed into the inflation data that they're looking at. So it behooves us to look at it too. I will mention one thing. I do track global central bank actions. And although we've saw, like last week, I think Canada raised their rates. Some major economies have been, recently raising rates. You would note, if you look at it, many emerging markets and frontier markets have been cutting rates. So it's about even now. We were in a situation for the last year or so where most central banks, whether they were developed markets or emerging markets, were all raising rates. But I'm starting to see more and more emerging markets begin to cut rates. Now, we'll definitely want to see places like China, the US, the EU, Canada, Australia, places like that peaking on their rate raising cycle, because that will have the most impact on liquidity. But we are starting to see more and more of these emerging markets, smaller countries, begin to loosen up. So I wanted to point this out. I'm going to talk about this a little bit in the next few slides, I think. This is from US Global Investors, a tweet from them. It says the NASDAQ 100 just had its best first half of the year on record, rising nearly 40% through June 30th, supported by AI plays such as NVIDIA, Meta, AMD, and more. Did you participate? And so you can see that this was, again, the best first half of a year on record. So I guess the question would have to be asked, is this an echo boom? Is this a reaction to the decline that we had last year? And we're heading further down. We're going to get into that in some of these slides. But this is what happens, right? So past performance, this is the kind of thing that I believe we're in a bear market. I believe that the bear market's not over. I believe that this was an echo boom. This typically happens after big moves higher in markets, in bubblicious markets. And I will show that an example from the tech wreck back in 1999, 2000, 2001. So here is a chart of the NASDAQ composite. You will note that it shows you the run up. This was the internet. This was, kind of the AI for you younger guys. You may not even been alive then. This is the hype that was around just when the internet first came out. The internet hasn't always been with us. If you go back to 95, 96, 97, when the thing was just starting to start out, and you would be up on AOL.com or CompuServe or something crazy, you had to hook up to your phone line. I mean, you could send email, you could do things like, trying to download, like you wouldn't be playing first person shooter games, let's put it that way. You had like baud rates of like 800 or something, and your memory and your computer, it wasn't like this. So when the internet finally got going and got up to speed, there was a big boom. It was going to revolutionize. It was going to change everything. I would suggest that 25 years later, 25 years later, we would all agree that the internet has fundamentally transformed society, some ways good, some ways bad. But without a doubt, it goes without saying that it has changed many things and created a lot of wealth, but it destroyed a lot of wealth too. And so, just for an example, if you look to like March, April of 2000 or 1997, you were at 1,194 in the NASDAQ, and then you proceeded over the next, let's say, approximately 3 years to go up 4 times, right? Or, well, not call it 4 times. We went to basically 1,100 on the NASDAQ to 5,100, which was the top, in March of 2000. And so that's a pretty big gain. You see this steady gain over time, and then you see this blow off that happened right before the year 2000. Now, the other thing that was happening during this time was also the year 2000 frenzy, where the so-called experts, the scientists, the engineers, everybody got this wrong. They said, when computer clocks rolled over to the year 2000, it was going to cause all of this discombobulation in computers and networks and all these things. And so there was a huge capital spending boom prior to that as people updated their equipment. I'm not going to get into the whole thing. You can look it up. But basically, that's what kind of precipitated this big push at the end. And this is something similar we're seeing with AI. Is AI going to change things and revolutionize things? I mean, I don't know. I can't tell the future. It seems to have a lot of promise, but is it really worth, the valuations that we see on some of these companies, like NVIDIA, for example? 40%, gain in the NASDAQ in 6 months. Does that mean we're in a new bull market, or is this just a bear market rally? I mean, we haven't exceeded, I believe, the previous highs, I don't think. But anyways, going back to this example, you will note that after the market peaked in like March of 2000, you had a big pullback, right? And then you had these, as this thing basically went from bubblicious levels, you were basically, I didn't play this all the way out. I don't remember what the ultimate bottom was, but I can show you individual stocks from this period that, had the same type of trajectory. Some of them went straight up, some of them went straight, right after that went straight down, and some of them went away. They went bankrupt, creative destruction. But what I wanted to point out here was the fact that during this bear market that lasted for a couple few years, you had several bull markets. I don't want to say bull markets, but bull reactions, right? Because what happens when this thing starts going down, you have sellers, you have short sellers start piling on, shorts cover. This is what happens in bear markets, right? The bear market wants to pull in as much true believers, after this initial decline, and then it starts climbing again. You can start watching CNBC and Bloomberg, and they'll say, "Oh, that's the end of it. We're in a new bull market." And no one ever goes back and looks at history, at previous hype cycles. I guess I could pull up the bear market before this around in the late 70s or back to 73, 74, the Nifty 50 stocks. It's all the same thing. It's just a different characterization of the narrative, because the human nature, the human greed, the desire to get rich without really putting any time or effort in, all of these things never change inside humans. And so you see the same patterns over and over. And so I just wanted to demonstrate this. I put this chart together real quick. I didn't put a lot of effort into it, so I didn't catch every exact bottom and exact top, but I wanted to make the point. We had this pullback, then you had this, bounce, and you had over the period of, let's say, from May of 2000 to July of 2000, you had a 35% gain. And then what happened? It rolled over. You had another big decline, right? These are called what I call waterfall declines. You had another big decline, okay? Took you down to lower lows. You couldn't breach. When you see the previous high not breached, and then you see like a double top formation, you have all these things happening. You have this shorter term moving average moving below the longer term. You have all of these things setting up negatively just from a technical analysis perspective. And so you have another waterfall drop. So we dropped down to 2251 over the period of the rest of the year, which is about 6 or 7 months. And then you had another bounce, right? 30% gain in about a couple months, end of the year rally, Santa Claus rally, right? And then you rolled over again. Couldn't breach the previous highs, lower lows, right? Lower highs. And then again, another waterfall drop to 1600. And then another short term, several month, March to June, 3-4 months, 2-3-4 months, you had a 44% gain, and just goes on, right? Then you have another waterfall drop. And eventually what happens is that every time this goes, less and less people participate in the next bounce, right? Because it starts getting through to people that the previous era is over. The valuations were too extreme. And then the market, again, going back to Mr. Farrell's rule, excesses in one direction are usually corrected with excesses in the other direction. Again, I'm not just cherry picking here. I guess you could go back to every other themed bull market if you want to go back far enough. Like I said, the Nifty 50, what have you. You could look at housing stocks and things like that prior to 2008. You could look at, many sectors and overall markets where this has occurred, where it's a new era. It's different this time. You hear the same justifications for the overvaluations and for the craziness and the bubblicious conditions. Now, somebody will say now on the comments, they'll say, well, you could have traded that. You could have made a lot of money trading that. Yes, you could have, but show me the person that did it successfully, consistently. See, this is the problem. I don't know about you. Maybe you're the trader. Maybe you're the guy that can catch most of these moves and you have the intestinal fortitude and you can hang in there and you know exactly when maximum pessimism is there and you can trade these bounces, okay, and not get sucked back into the mentality and the bias that, well, this bear market's over, we're going to go on to new highs, because that's what you'll hear during these things. And maybe you're that guy. I'm not that guy. I can't do that. I've tried it earlier in my career. I couldn't do it. I'm not good at it. I gave it up. Again, I look for themes that have a long runway. I look for inflections. I look for undervaluation. I look for excesses in one direction to be on the downside that are going to be corrected by a change in events, a change in perception, a change in sentiment, which leads to a reaction and a revaluation to the upside. That's what I do. And that's more fundamental analysis. But again, you can go back and look, on this drop that basically went from, and I didn't play it all the way out to the ultimate bottom. I forget when the bottom was, but let's just use this chart and assume that this next, I don't know what the ultimate bottom was. I guess I probably should have looked it up. But anyways, just over this period of 1-2 years, you had 1, 2, 3, 4 bounces over 2 years of between 30 and 50% basically. Okay. And so, but ultimately the overvaluation gets corrected. The excesses in the upside got corrected to the downside. And so that's what I think we're in today. I used Jesse Felder, had a very good tweet this week. It said, watch for moments when people are so optimistic they think things can only get better, usually expressed in the dangerous view that there's no price too high. That's what we're hearing. We're hearing justifications for these high prices, like in NVIDIA, for example. I don't want to pick on them, but just comes to mind. And the crazy valuations and the market cap of the company vis-a-vis what is the current total business of AI. And so then you'll hear the WAG will come back and say, well, you need to extrapolate out into the future. Well, you don't know if NVIDIA is going to capture how much of that market they're going to capture. You don't know the future. No one does. And it's hard that's why you have to use some valuation metrics. You have to look at, previous history. Am I in a new era? Am I at the bottom of this thing? Did I catch the bottom? Or am I in a situation like I was before where there's a lot of hype? Companies, you're starting to see it. A lot of managements now, somebody did a search. That's one good thing about AI and about search engines and Google and things like that. People went out and actually looked on company quarterly reports, how many mentions by management of artificial intelligence. Well, it's spiking. It's what you see, right? It's the thing. It's the new thing. Okay. So it's the new shiny object. So everybody jumps on it. So again, this quote from what Jesse Felder put up on this tweet: watch for moments when people are so optimistic they think things can only get better, usually expressed in the dangerous view that there's no price too high. Likewise, recognize when people are so depressed they conclude things can only get worse. And that's the arena that I like to play in. Okay, getting into some news here, things that we've been following. BASF, which is the very large international German-based chemical company, cuts 2023 earnings guidance on weak industrial demand. German chemicals giant BASF on Wednesday cut its full-year earnings guidance, the latest in a string of chemical companies caught out by weak demand from industrial clients and higher interest rates. Global chemical production declined precipitously in the first half of 2023, BASF said in a statement, putting this down to slowing growth in industrial output. Well, we've shown that, right? We know that manufacturing around the world is in a recession. Global PMIs are well below 50, heading lower, and so we're seeing this. It says second quarter adjusted EBIT dropped 57% to 1.01 billion euros, down from 2.34 billion a year ago. That was in line with a 1.02 billion euro average analyst forecast. Okay, so this is what we see. I mean, and how much of this now is also going to be affected by the industrial policies that are being followed in the EU with the energy. The energy situation is a kind of a falsely been cured. It's a false sense of security. I think it's going to reemerge this winter. If we have a normal winter, we'll see. Again, we can't know the future, but I do know for a fact that BASF is, when they are building new plants, a lot of them are, I know of at least one facility being built here in Texas, okay? That's to take advantage of the lower feedstock and energy prices that they enjoy here. So anyways, I thought this was, we've been talking about this company. It's the largest chemical company in the world. And what they say has to, be taken into consideration, because chemicals basically are raw materials for so many other products that if you're seeing chemical demand going down, then certainly manufacturing and ultimately the economy is probably weakening. Positive, we just want to talk this. There's a guy on Twitter I would follow. I think he goes by the name Tommy Deepwater. He puts out these little, I don't know if he has a service, but he occasionally drops these things onto Twitter. And he was talking about 2023 return of the drill ship, and you can see why we're so bullish. A lot of little good diamonds here. It says many deepwater projects now have break-evens in the 30 to 40 barrel range, well below U.S. shale. One thing I want to mention about deepwater, there was a lot of, or offshore in general, it's definitely in an upswing now. That goes without saying. You can see it. We've been talking about it. We were there long before most people even knew what was going on. We had to suffer through one false start back a few years ago. Where we got in a little bit too early, then we end up having big precipitous drop. Spending was increasing, but we had to suffer through a precipitous drop due to COVID and some other factors, and basically had to sell out. And then now this looks like this particular run, this particular recovery certainly has legs. It's well established and in effect. But now you're starting to see more and more people talking about it. It's going to gain, more and more capital is going to start flowing into these stocks. And again, what I wanted to mention was, we're seeing the increase in activity, and people say, well, what's the big deal? The big deal is that the shale basins are peaking. And so if you're a big company like Exxon, you're like, okay, where do I need to go to replace reserves? And when you have a prospective basin like offshore Guyana, which is basically went from zero, it's going to end up probably hitting in the next year to 18 months, 2 years, something like that, 1 million barrels a day of production. That's where you're going to put your money. Part of the problem was when we were in the pandemic, when oil prices went negative, the sentiment got so bad in the markets. I mean, a lot of these companies they didn't know what was going to happen. They didn't, we had all this knucklehead talk about oil was going to go away. See, it proves that, we locked down the world and, we don't need oil anymore, which was stupid. We took advantage of that and had several 10 baggers coming off that bottom. But anyways, the bottom line is that you're starting to see final investment decisions being made. Offshore is a long-term, multi-year commitment. Those weren't being made. People like shale because anytime oil would spike 10, 15, $20 a barrel, you could do short cycle well drilling in these basins, right? You could just dial up some rigs, go out there, sink a well, and start generating cash flow fairly rapidly. offshore, there's no shortage of offshore projects. There's no shortage of oil. There's a lot of work has been done to find where these basins are. Now it's just a matter of going out and drilling them. And so this is what we're in. This is the situation we're in. So it's not like a lot of frontier exploration is happening. A lot of it's just like, okay, well, we think oil will stay in this anywhere from, I don't know what they're using on their price assumptions, but $60 to $80 a barrel, whatever, that the large internationals use. Every one of them is active. Exxon, Shell, Total. That's happening, right? So they kind of have an idea where a lot of this stuff is. There's been a lot of pre-work done, seismic, or the work that needs to be done, geophysical work, and so, for example, offshore Namibia, I'll mention that what Shell just found. So what I'm trying to say is that we're in an upcycle. It's been established. It would have been better. Is there still opportunity there? Yes. Is the opportunity the same it was a year or 18 months ago? No. Again, this is why I think I have to plug the Actionable Intelligence Alert newsletter. We get into these situations for the most part well before most people are talking about them, and that means you have to sit there and wait. It was, we got it wrong the first time, and people that are long-term subscribers to my newsletter know that. But now we're enjoying fruits of, we made the initial entry a little bit too early, and now we have an established trend, and we're reaping the rewards. And this thing has legs. So, anyways, getting back to Tommy Deepwater slide here. He goes on to say substantial ETS floater supply. He's talking about rigs that float, semi-submersibles and things like that, has been scrapped. No new build orders expected for years, with current estimated costs of $1 billion with unfavorable terms, large deposits. We talked about that before in the past. Why, if you go to a yard now and want to build a drill ship or one of these big floaters, they're going to want a lot of that money up front. They're not going to self-finance it. They're not going to just tell you, okay, we'll start building it if you give us 10 or 20% down. It's not going to happen. Onshore frac spread count is down 9% year over year. Shale E&Ps are now paying large dividends rather than growth. Talked about that. Talked about the fact in the past, and reiterating the fact that just the Goring and Rosenzweig analysis of the near term, when I say near term, year to 18 months time frame of the Permian Basin peaking, then that will join the Bakken and Eagle Ford in terminal decline. And so the capital is now moving offshore into these longer term projects. E&Ps and IOCs now have a lot of free cash flow to internally fund large deepwater CapEx projects. Countries and national oil companies are placing a premium on energy security and want to exploit their offshore resources. There is no next shale play like the Permian in 2015. I would argue that the Vaca Muerta is pretty substantial shale play, but that's limited by the fact that it's in Argentina and there's capital problems, there's government problems, there's equipment problems. So that's not going to pick up the slack. Instead, he goes on to say, because there's no new shale, instead it's deepwater Brazil, Guyana, Namibia, Suriname, and more. Most deepwater plays are heavy oil weighted, unlike U.S. shale that is gravitating toward more gassy. U.S. onshore drilled but uncompleted inventory is at its lowest level since 2014, less low-hanging fruit. Long cycle, that's what we're talking about when we talk about deepwater. This is the last point he makes, or he or she. It took about 7 painful years for the deepwater market to correct. Deepwater cycles last a long time. That's true on the downside and the upside. So we're in an upcycle. I think it'll probably be the biggest one of all time. Not trying to hype it, but again, the major theme we had, going back to what he said in one of the points here, is there's no new builds for anything, for no equipment. Eventually, after a couple of years, and the cash flows are going to be so large, okay, when, if you see for a drill ship $700,000 a day, we're just now bumping up against 500. They could go higher. Why not $1 million a day? There will be a time to sell. There will be a time where the cash flow is so big they can't buy back enough shares. They can't pay enough special dividends. They can't pay down any more debt that they're going to start they'll say, well, we'll just finance it, because that's the mentality that seeps in, right? Well, the good times, it's been good, recency bias, this is what they've done in the past. That's not on the near-term horizon, but eventually that will probably kill this industry. So that's a long way off, in my opinion. But this is tremendous. These 8, 9, 10 bullet points. This is exactly why I think we're going to have a tremendous bull market. And again, these things have a tendency to surprise both on the downside and the upside. And I think we'll probably end up seeing that over the next couple of years. Just to emphasize that, the CEO of Seadrill, which is a Norwegian offshore oil driller, here's a quote from him. It was a headline from an article from something that he said last month. It says, quote, "We'll be generating a wall of cash," unquote. Seadrill CEO eyes dividend return with rig rates tipped to pass $500,000 per day. Head of Norwegian deepwater driller says shareholder returns are a focus, backed by improving day rates and contract terms. So there you go. That's what we'll be seeing from all of them eventually. So talked about this, just mentioned it earlier. Here we go. Shell makes fourth oil and gas discovery offshore Namibia. Namibia, in my mind, if you take South America and push it against Africa, they kind of, before the continent split, as these things over millions of years separated, and the rivers drained into and created these different sediment layers where oil and gas could, develop. If you assume, I'm not a petroleum geologist, but it makes sense that with all of the activity offshore Guyana, Brazil, that you would see a twin or a sister situation offshore West Africa. Now, certainly in Nigeria has been very prolific. Angola has been very prolific, but this emerging petroleum situation in the Orange Basin offshore Namibia and stretching around to the southeastern portion, south portion of South Africa seems to be another emerging offshore a prosperous zone. So Shell has made a fourth hydrocarbon discovery offshore Namibia, one of the hot spots in offshore exploration right now. The UK-based supermajor said on Wednesday that it had confirmed the presence of hydrocarbons in the fourth exploration well, Lesedi 1X, a completed drilling offshore the African country. Quote, "What we're most pleased about in Namibia is that we have so far, out of the 3 exploration wells and 1 appraisal well that we have drilled, we have had top quartile well performance in every single one of our activities in Namibia," unquote. Since Shell and another supermajor, France's Total Energies, have recently made some large discoveries in the Orange Basin offshore Namibia. You will recall that one of the, I think the largest offshore discovery last year was the Venus 1 well, which is in the Orange Basin by Total. I mention this because this is worth watching, because I think this could develop very easily. Again, there's no guarantees and no one knows the future, but as more and more wells are drilled, we're starting to get an inkling, or at least some suggestion, that offshore Namibia could be, is this going to be Guyana 2.0? Who knows? Likely it won't be as prolific, but this certainly seems so far prolific. Every time one Shell or Total drills a well, they come out with these tremendous announcements. This is what they're saying. They have had 3 exploration wells and 1 appraisal well, and they're all top quartile wells. So they're not duds. I mention this not only because this is great for offshore, as we pointed out last week. I think that there's 19 or 20 rigs marketed in West Africa. They're 100% spoken for right now. So there's a tremendous demand for rigs. Same thing in Brazil. The other thing I would mention is that it's like, okay, well, how is this actionable? We talking about these news items. This is one of the things I talk about in the newsletter. This is all well and good, John. This is very interesting and entertaining, but how do I make money off this? Well, you're not, this individually is not going to single-handedly affect the overall business of Shell or Total or Exxon. I mean, they're good things to have. We're in an energy bull market, but what you need to look for is is there another vehicle, is there another opportunity that these type of discoveries that has more torque? And in the newsletter, we have a company, it's a smaller company that owns like 35% of another entity that is partnered with Total on that Venus discovery and surrounding blocks. So we have a company that has a pretty significant holding in what was the largest discovery last year. Why I mention this is because although if this thing Venus ends up being 3, 6, whatever billion barrels, and then the surrounding properties, it turns into a new petroleum area, development area over the next couple few years. Like I said, it won't necessarily be super material to Total, but to this company that we have in the portfolio, it would significantly be material, and it would definitely cause a revaluation of the stock. This particular company is run by some folks that basically have a significant cash flowing entity in offshore Nigeria, and they have used the cash flow from that particular project to fund entry into various what I call lottery tickets in places like the Orange Basin, like offshore Brazil, in Guyana, all these emerging petroleum areas. They've bought into other companies that have interests in these areas, and so they've spread their bets around. And we're starting to see now if you want to use the analogy of, or metaphor, whatever you want to call it, of planting an orchard, and now we're starting to see some of these trees bear fruit. So again, we don't just talk about these things because I find them interesting. We talk about them because they're actionable, and we go out. I try to go out and find, ways to actually take advantage of this and make it actionable for my subscribers. So that's why I'm talking about this. We do have some lottery tickets. We do have interest. We do have a company in the portfolio that has interest in all of these areas. And like I said, it's not a super major, so any kind of discovery will be material to this portfolio holding. So OPEC sees more 2024 oil demand growth than the IEA or EIA. Now, again, you have to be a little bit, look at these things with the view that OPEC is self-interested in seeing demand go up, obviously, but this is in the context supposedly of, a lot of countries in recession. And what I get back to is the continued oil demand increases, demand for increase in emerging markets that no one really talks about. I've been surprised, I think, really watching how the underinvestment we've been talking about, not just in oil and energy, but all materials, even though we're in many areas, major blocks, economic blocks, i.e. the EU, China, the United States, are definitely in manufacturing recessions, and in some places full-blown recessions like Europe. We're still seeing petroleum demand growth. And why is that? Well, that's because you have places like India, Indonesia, the Philippines, Bangladesh, all of Africa. These places continue to grow, and they continue to require energy inputs to grow. In order to have economic growth, you need energy inputs. We've talked about this 100 million times. And so what I'm suggesting to you is that although we have to watch this, again, we've talked about this before, even I think there's only been like 4 times in the last 50 years where worldwide oil demand has not grown. And 2 of those times were, well, the pandemic and also like the great financial crisis, and 1 year of the great financial crisis, and I think 1 year of like the internet bubble. So you need a really just having a run-of-the-mill recessions don't necessarily lead to decreases in petroleum demand. And the thing that people need to keep in mind is that the emerging markets are driving a lot of this, okay? And people are not keeping that in mind. That's why I bring up the, like how much air travel, for example, is expanding in India. It's not that just air travel alone in India is going to drive oil prices higher. It's just an example of what's happening. You know, somebody pointed out that currently in India, I pointed this out several weeks ago on one of the slides. You know, Southwest Airlines has a fleet of 700 aircraft. That's just one airline in the US. That's the total commercial airline fleet in India for a population that's 4 times larger than the United States. So you see what's going to happen. You see that there's going to be just built-in growth as the country becomes wealthier, as the middle class develops. What do people want to do? They want to travel. So that's just one example, right? You know, you're not even talking about a continent like Africa where, you know, they're so far, they're, you know, India is just now entering where China was, you know, on energy growth 20 years ago, and Africa is probably another 20 years behind that. So you have this built-in upward bias in demand that even if you reduce demand in the West, the populations and the economies are going to grow so large in the emerging markets that it'll it's like when somebody said like 10 years ago when they first started talking about climate change and reducing carbon, all this, one guy said it doesn't really matter. I forget who it was. It doesn't matter if the US and Europe and all these countries in the West and the OECD countries want to reduce their oil demand, it'll definitely get sucked up by the emerging markets. So just something to keep in mind, that you know, this is going forward. Obviously, we're only in Q3 of 2023, but you know, you're talking about this time next year adding another couple few hundred or couple few million barrels of oil, which we don't have. I don't see that we have. So we have this spike coming, in my view. That's what I'm trying to point out here. You know, the economies are, by this time, I don't think they'll still be raising rates then. I mean, at some point, liquidity is going to come back. People are going to be wanting to stimulate their economies in these places. They're going to do what they always do. And once that, you know, even the demand comes back in the developed countries, the emerging market countries will even further accelerate their demand. So I think we have an issue. We've talked about it before. That's why we're so bullish on offshore. I mean, that's where the growth and supply is going to come from. And like I said before, it's not the market, it's not the industry it was even 5 years ago or 3 years ago. There's been so many companies that went bankrupt, so much equipment's been mothballed or scrapped. And again, going back to what Tommy Deepwater said, there's no impetus, there's no incentive right now, there's no justification to go out and build a bunch of new drill ships, a bunch of new offshore service vessels, nothing. And the managements are saying the same thing. So that's where the tremendous opportunity continues to be. China crude imports hit 3-year high. I mean, China's basically kind of in, you know, at least reduced growth, if not recession. I know the manufacturing there's in recession too, but it says China crude imports reach 3-year high in June, grow to 12.7 million barrels a day, 42% up year on year. Crude stocks at 980 million barrels, same as June 22. On the other hand, Chinese buyers lowered nominations for August, loading from Saudi Aramco. Other Asian refiners were fully allocated. So, yeah, I mean, the Chinese are very good traders. They buy when oil's cheap. They have tremendous storage capacity now. They do sell oil when it gets high. They play the market. So, but again, you know, we're most of the, you saw it in the data. What I'm trying to point out is we're back to the pre-pandemic levels and starting to exceed them now in many, many countries. We've seen that just last week or just in travel data here in the US, where we're above the 2019 peaks now before the pandemic in air travel. So expect to see higher numbers for demand over time. This is something that I think is helping the price recently. You know, part of the OPEC Plus, which is Russia, you know, they had agreed that Russia was going to cut 500,000 barrels a day. And that was, you know, back here in February. And basically the Russians didn't do that. They kept, you know, pumping. But you'll see that recently, since in June, crude shipments from Russia they're starting to cut back and do their commitment of 500,000 barrels a day cuts. So I think you know, it takes time for these things to feed through, right? You have to you start making cuts like Saudi did and OPEC and Russia, these things take time. And the Russians basically weren't following their commitment back in February, but evidently they are now. So again, we have a lot of things in motion. There's a lot of things that go on in these energy markets. I think long term, if you think of it from a long-term perspective, you'll be, and especially from the service side. So and then again, offshore. I actually have some stocks in the portfolio for onshore service, particularly in Canada, but they're not performing that well. And I think with, seeing these shale basins like starting to peak in the US, and the Permian coming up on its peak, I'm actually thinking about reducing my onshore service and rolling that into offshore. Offshore just has it just has a boom written all over it. And you have like unlimited almost right now opportunities for drilling offshore. And we see areas onshore that, again, we've had 2 basins in the US that have reached their peak and a third that's coming up on its peak. So that's just an oil. Not even talking about the Marcellus shale basins, gas shale basin. But anyways, you know, these are hard to forecast in the short to medium term. But I think as long as you keep that longer term perspective, that way you don't really have to worry about the oil price too much. I said in one interview the other day, a few weeks ago, there was a possibility you could see oil get to 50 before it goes to 150. Again, it's impossible to predict near or midterm. We don't know what the effects will be. But what we do know is that even if you get down to 50, you're still looking good because these offshore projects are viable down to $30 to $40 a barrel. And now that the international oil companies and national oil companies are making those billions of dollars of investment, they've decided to move forward as sentiment has changed to focus more on these longer term prospects. That's where your opportunity is. It doesn't matter really what the oil price does. I mean, I don't think there's anybody out there thinking that oil is going to go down to 20 or 30 or $40 a barrel and stay there. That's simply not going to happen. So, you can never say never on anything, but I think that's really where, if you focus in on energy specific to oil and gas, yes, there's opportunities. I do own some oil companies in Canada. There's some that are excellent producers. You have the new pipeline that's coming online that's going to move probably lower differentials for some of that crude in Canada. There's some good companies up there, and I have them in the portfolio. I have some, like I talked about, the speculative entity that has some upside based on what's happening. So I do own some oil companies, but I just think the majority of your opportunity is probably based in oil services, in particular in offshore. Again, here's coming out of the pandemic. Here's your jet fuel demand basically doubling in the last, year and a half as air travel has increased. That's going to continue in my book. I wanted to talk about this. S&P came out with their critical minerals report. It's free. I'll put a link to it in the show notes. Again, I wanted to point this out. We're starting to finally see now a couple things I wanted to point out from the report. I'll put a link. It's like 50 pages. It's free. I would take a look at it if you're interested in the energy transition and kind of the whole reason why one of the themes I have in the newsletter and in my investing thought process is the heads we win, tails we win more. Again, lack of investment in finding new mineral resources, yet the demand for them is going to be tremendous. And so that's an opportunity that we can arbitrage. One of the things we've done in the newsletter, instead of trying to, again, fixate on what the copper price is going to be, try to pick which company and which jurisdiction is going to do well. We try to follow the Levi Strauss methodology, kind of the similar situation like we have in energy. Instead of focusing on the oil price all the time or what particular company is doing what in what basin, it's just like the service providers. I don't have to worry about that because I know that the exploration spending is increasing. So how can I take advantage of that? And so that's what I'm doing also in like gold and these other minerals. Yes, I do have some speculative gold positions in my own portfolio. I don't put them in the Actionable Intelligence Alert portfolio because they're too volatile, but I did put in a company that can give you torque to these increasing exploration budgets. And this is what you see. Exploration spending continued to march upwards, led by Australia and Canada. Exploration spending for selected non-ferrous mineral resources. As you can see, from the bottom of the pandemic, less than $4 billion a year. We're now pushing towards $6 billion a year. And like I said, there's ways to take advantage of that. That's a 50% increase in a couple of years. It's going to probably move higher. You see that tremendous amount of exploration just in the US and Canada. The one company that I did have in the portfolio that does facilitate exploration for mineral companies has a large amount of their business in Canada and the United States. And so you see over here by commodity where the exploration dollars are going. You see a large part of it is copper. Then you see the various other minerals that are being explored for. So expect this to continue because you're going to have to overcome again years of underinvestment in the context of increasing demand that simply is not going to be able to be met unless we have a tremendous amount of exploration and new development. And again, we don't have to wait on a mine. We don't have to look at the Lassonde cycle and say, well, okay, well, they found a resource. Is this management capable of bringing the resource in creating a mine, and how many years does that take? I would rather just say, okay, we get the exploration dollars through this entity that helps with exploration, and then they move on to the next project. They don't have that risk. The only risk they have is a major downturn in mineral prices, which don't facilitate a spending boom in new exploration. So again, the returns won't be as much. I mean, there's a certain excitement to buying that junior company for 15 or 25 cents, and then it hits something on its drills, and then it explodes and goes to 25 cents to $2, or you get a 10 bagger in a year. There's a certain excitement to that, but that's what I'm trying to do is build wealth over time consistently. And crapshoots and lottery tickets are not the way to do it. They're fun. I do participate in some things because I think certain companies have upside. There's some companies that are continuing to build out their resources with good managements, but there's a lot of trash out there too that you shouldn't get near. And so, as cash flows go up with these mining companies, they're going to devote more and more money to exploration and delineation of existing resources, and that's going to flow to this particular company in the portfolio. So again, strong cash flows are driving growth in investment and exploration spending. This is from the Critical Minerals Report. It says exploration spending also continued its upward march in 2022, up by 20%, driven primarily by record growth in lithium exploration, followed by copper and nickel. Canada and Australia led the way with over 40% growth year on year, notably in hard rock lithium plays. Strong cash flows in 21 and 22 have enabled the mining industry to allocate a greater amount of capital to new developments, exploration, and mergers and acquisitions, while the remaining surplus has been returned to shareholders and creditors through dividends, share buybacks, and debt repayment. It says in the report right now it's about 50-50 right now. You're getting 50% of cash flows going to new developments, exploration, things like that, and then half back to shareholders and banks. So again, I would read the report if you're interested. A lot of graphs and there are a lot of charts, very bullish from that perspective. So take a look at that at your convenience. So that's going to be, I'm going to caveat this going forward. There's going to be some stuff that's going to be some political commentary or commentary on what's going on in the world. Some people won't like it. There will be some commentary about Ukraine. This concludes the economic and financial portion of this week's video. I will make a few comments now on a couple other things. I think they ultimately have effects on your finances and ultimately you as a person in this world. But again, some people don't like that. So this would be the time to go do something else. This slide right here is from the Daily Mail. It says, I titled the slide, "They don't want you in an electric vehicle. They want you on buses and metros. They don't want you moving around." Okay. They being the masters of the universe, these technocrats that are slowly but surely trying to take over the West. It's from the Daily Mail. It says, "Owning a car is outdated 20th century thinking, and we must move to shared mobility to cut carbon emissions," the transport minister of the UK says. Owning a car is outdated 20th century thinking. Trudy Harrison is also Boris Johnson's parliamentary private secretary. She said the UK should move to shared mobility to cut carbon emissions. Well, there you go, folks. This is also the place in the UK where they're moving towards these 15-minute cities. Of course, when this is brought up, it's poo-pooed. These are not conspiracy theories. This is what they're doing. Most people won't pick up on it. And quite frankly, there's probably a good proportion of the population, I've said before, 40, 50%, they want this. This is what they want. They want to go along with it. And what's frightening to me is they don't want to have debate about it. They don't want to have a discussion about it. They want to do it, or they're apathetic, a large portion of the population that doesn't really care one way or another, because as long as they, can go to their football games and, have enough money to get some beer or do whatever they want to do, they're fine. They don't care. And what's the big deal? Everybody should ride the metro. What's the big deal? And so this is where we're going, right? And these technocrats, this is Boris Johnson's parliamentary secretary. Isn't Boris Johnson supposed to be a conservative? I mean, that's why I tell you folks over and over, you're not going to vote your way out of this. Okay. This is where they're going to take you. Hopefully the economic collapse comes such that they won't be able to finance it and we can have true revolutions. But you see what happens even in places like France and these other places, they constantly have protests and everything, and the policies don't really change. And so I think these things will continue until there's economic collapse such that the pain is so bad that the people have no other option but to rise up. But we're a long way from that. But I wanted to point this out. They just continually, like I said, it's always 2 steps forward, 1 step back. When the 15-minute cities were being proposed, well, this is just an experiment. What's the big deal? It's not a big deal. We're not going to limit your mobility. You're overblowing this. That's what they say. But this is where we're going, because look, guys, this whole thing around carbon emissions and global warming, I'm done with it. I don't argue about it anymore. It's a grift. It's a scam. I mean, one of the congressmen said that right to John Kerry in testimony this week. I think it was this week or last week. So you just, in order to do what you want to do, Secretary Kerry, because he's the climate change secretary, czar, whatever. He's just a grifter, man. And where would this guy be without the catch-up money? But anyways, he called the guy a grifter to his face. He said, "You're just grifting like everybody else." I mean, this stupid thing about sequestering carbon out of the atmosphere, this is the reason why Exxon bought Denbury Resources the other day. It's not because Denbury has all these resources, because they have an extensive CO2 pipeline network that moves through East Texas oil fields and from Louisiana, where they pipe CO2 into these wells. And they're going to be able to get a benefit from that from the IRA. This is another reason why Warren Buffett has been buying a ton of Occidental Petroleum stock. It's not because just Occidental Petroleum. Well, not only the fact that Occidental Petroleum is probably well positioned for the upcoming spike in oil prices because of the supply issues we're going to run into, but they're getting big on building these carbon sequestration plants that are going to be financed by the federal government. So there's a tremendous amount of free money out there. When there's free money, people are going to do these things. Go look up Denbury Resources and see how they make their money. I mean, they've done enhanced oil field. They buy older oil fields. They go in, their engineers look at it, and they pump CO2 into the ground, and it pushes additional oil to the well bores. It's a very good tactic that's been done for a long time. So not only will they get the oil, but they'll also get the tax benefit of doing that. And believe me, with Exxon having the resources it does, it's certainly going to ramp that up. Okay. So it's always about money, whether you understand it or not. It's just about money. It's like cui bono. Who's benefiting from this? It's like getting back to what Kerry's, the one congressman told Kerry, what you want to do would cost $1 quadrillion, some crazy number. He said, you're just grifting like everybody else. That's true. So this is a tweet. I know the German listeners don't like me picking on them. I'm not. I'm just saying, this is from a friend of mine, wandering investor, acquaintance that he travels all over Europe. He's doesn't have a high opinion of statism, but he pointed this in his. I didn't put his part of the tweet where he said, unless things change radically in Germany politically, it's over. Germany's over. And it says right here, this is the tweet he was quoting. The highbrow German weekly. I don't know if it's highbrow. I don't know. I'm just saying. Die Zeit, I guess it's pronounced, is asking its readers which essential restrictions and bans the government should impose on citizens, or if they get their way, subjects. And here's the desire of left-wing German intellectuals to create totalitarian systems is seemingly unbreakable. So we are seeing, like I said, there's always a reaction, as Bob Farrell said, in financial markets, also in society. There's always reactions. This is what you're going to start noting. One of the things that the Marxists, Bolsheviks, communists, whatever you want to call them, these people that are in power now are just, neo-Marxists, in my opinion. When the reaction comes, which it inevitably does to their anti-human policies, anti-intellectual policies, they crack down. They don't have debate. They don't have and say, let's put it to the people. They will crush the debate. They will crush the opposition. That's what they've done throughout history, to the point of liquidating entire populations. Am I suggesting that's going to happen? No, I'm not right now. But I'm telling you that that's their MO. They're not going to debate with you. And as long as they have power, they'll do everything they can to limit debate. That's why they're trying to crack down on the internet. That's why they're trying to throw people off social media. You've already seen that. I mean, if you have your eyes open, you get it. If you don't, I mean, you're not going to get it. Some people just aren't going to get it. As they say in some of these markets, you're just not going to make it. And, you're just going to float along like a cork or a bobber. And whatever happens to you, happens to you. You just don't have a clue. And there's unfortunately a lot of people like that. But here's the headline: what should you be forbidden to do? And this is all about what should you be forbidden to do to protect the climate, as if the actions of the German people have any precipitable effect on anything in a global context. They don't. What they could do is turn their nuclear reactors back on. As a matter of fact, you're starting to see cracks in even in the Green Party, because there was a legislator there in Germany, I forget his name, that even suggested, at least brought up the subject, that maybe we were too hasty in shutting the nuclear reactors down. We'll see if that gets any traction. Probably not until you get a new government. So I put this up here. I know this is really going to trigger people. This is the song from The Who, if you remember that, from The Who. Blue Eyes, I think, Behind Blue Eyes, but I just took this as no one knows what it's like to be the sad man. Here's President Zelensky at the NATO summit. This is not Photoshop. This is an actual photo. You see all the big wigs. You see, I think this is the Prime Minister of the Netherlands that's out now. His government collapsed. Here's Macron. I don't know who all these other idiots are. They're all the masters of the universe, right? They're all the ones, all of these globalists, all of these scumbags, all these horrible people. And he's standing here in his Mao outfit. This guy's stolen hundreds of millions of dollars, and he can't put a suit on. I mean, I know this is part of the act. It's part of the narrative that they've created, but it's here he is standing here by himself. There's another picture where he's looking at the camera, forlorn, looking back at us, forlorn. All these people have their back to him. They don't want anything to do with him. It's over, folks. There was no guarantees. Nothing came out of there. And so now, from my understanding, it's over. It's an attritional battle. The super terrific counteroffensive that was going to split the Zaporozhye province and the thrust to cut the Russian land bridge, it didn't work. It's not going to work. Ain't going to happen. And so now what happens? So basically, these masters of the universe had a plan that they're, they were going to destroy Russia financially. That didn't happen. When that didn't happen, they weren't prepared for a long, World War I type attritional battle. And we found that out now. We're out of ammunition in the West. We're out of resources in the West. We spent $890 billion on defense in the U.S., and we don't have enough shells. We're sending cluster artillery rounds now because we don't have any other high explosive rounds to send. And as these people are just getting chewed up. I mean, I don't even go on the Telegram channels anymore, and it's just too terrible to look at. The videos of, after action when the soldiers from both sides are going and bodies ripped apart, strewn, equipment all over the place, blown up. What is this for? What is the reason? And so now there's only two choices left for the globalists, right? This guy is probably going to end up dead or on the run. He'll probably run to Israel. He has a place there. It's over. There's not, he's still saying he will not negotiate with Russia. There's going to be a negotiated settlement on this thing eventually. That's how all wars end. This one will too. The problem is now that the Russians have stated very emphatically that they're not interested in negotiating. They're going to impose, they said, and I feel like in their minds they have the momentum now because they said that the West is not agreement. They can't make an agreement with the West. They cannot be trusted. Whether you like it or not, whether you agree or not, you cannot put forth a context of where Ukraine expels the Russians from this territory. As a matter of fact, they're going to lose more territory. This is an attritional battle. They don't have the resources. Ukraine's fully dependent on the West, and the West is tired of this now. I mean, basically, from what I understand, from what was reported, not in the mainstream media, but from alternative sources, that Mr. Zelensky was told straight away, you have to show major progress by November or this year, or we're cutting back on the, we have no choice. We have an election coming up in the U.S., and Mr. Biden or whoever they stand up, whether it's Newsom, Michelle Obama, Biden, I don't know who's going to end up running for the Democrats, but they have to show some progress here because the Republican, if it's Mr. Trump, is going to just beat them up over this. Okay, there's nothing. You're $200 billion into this. I don't know how much the U.S. is. $100 billion into this, and there's no sign of anything happening. Yes, there's going to be the wag now that comes into the comments and says, no, the Ukrainians are pushing back. It's not going to happen. You can show tactical progress all along the front for both sides day to day. Strategically, explain to me how Ukraine wins this war, how Ukraine expels the Russians from Crimea, from Zaporozhye, from Kharkiv. It's Lugansk. It's not going to happen. Okay. And so the Russians have spooled up into a wartime economy. NATO has not done this. Again, we're sending cluster artillery rounds because we don't have any more high explosive rounds to send. So you have this all these Wunderwaffens that were supposed to change everything. The Leopards, remember, that was going to change. We're going to maul them with our Leopards. The Bradley fighting vehicles. They have a particular point on the battlefield called Bradley Square because there's so many blown up Bradley fighting vehicles. The bottom line is that there's only two forward paths for the globalists, i.e. the United States and NATO on this. They can climb down, find a way to climb down out of this thing, which is going to be very, very hard politically to do, or they can escalate this thing into putting U.S. and European ground troops in or into a nuclear war. What do you think is more likely? Okay. Eventually, as they run out of weapons, as they run out of ammunition, the Ukraine's fully dependent on the West for everything, for their economy. There is no economy there anymore. So constant injections of billions of dollars per month just to sustain the state, not only the military, and there's no desire to go to the next level. Even though you have crazy people like in, this idea that, Poland and Lithuania are going to come in and do, I mean, they don't have the ability to do anything. Where's their, are you going to come in and actually fight the Russians? Okay, that's not going to happen. Okay, and if it does, it would just be another mistake. So we'll see what happens. I can't predict the future, but no security guarantee, no pathway to joining NATO. Did you find out? I mean, I said this at the beginning. This is going to end horribly for millions of people in Ukraine. Okay, there was a deal on the table in March of 2021, and Boris Johnson got on a plane, flew over there, and told this man that if you keep fighting, we will supply you with weapons, we will supply you with money, we will, they kept dangling that NATO and EU carrot, and you see, this is kind of the whole thing in a nutshell right here. No one's talking to this guy. You can go back and look at some of the videos when at the end when Biden was talking, and they just pushed some handlers. Just Zelensky came up, they were all milling about the podium, and Zelensky was trying to even make eye contact with Biden. Some handlers just pushed Zelensky out of the way. It's over, and it's just a matter of time now. And I know many people will disagree with me. I would just suggest, before you want to, point out that in whatever small village that the Ukrainians pushed in 2 kilometers, and tell me strategically how they win a battle of attrition. It's not going to happen. The Russians are becoming stronger militarily, and I guess again, I've talked about this whole view that I think that the U.S. and Europe had was, it didn't happen like they thought it would happen, and now they're stuck and they're relying on a Deus ex machina event where something miraculous from God's going to happen to bail them out of this thing, and that's not going to happen. They're going to have to climb down one way or another. They're going to have to negotiate with the Russians at some point, or what I think is another possibility, as this thing starts falling apart, you can kind of see what happened in the Third Reich at the end of World War II. After that particular person that was in charge there killed himself, there was even at the end, there was jockeying for position of who was running things, who was trying to cut deals with the Allies, who was trying to minimize or fix their position. That's what you're going to see here as it gets near the end, because every fanatic, even the thing about fanatics is that even deep down, the fanatic has a doubt that he's wrong. And so at some point, opportunists are going to say, wait a minute, this isn't going to work. We're not going anywhere with this. Coup d'etats start happening. The military takes over a certain faction and says, okay, we're going to cut a deal with the Russians and end this. That's what I think could also happen. But this just won't be able to continue ad infinitum just because we simply don't have the production capability to keep up with the Russians. It's just that simple. And you can just see it day to day. There is no more. People say, well, we should just give them F-16s and all of our Abrams tanks. Have you not learned anything? The whole thing has changed on these battlefields. We're not fighting the Iraqi army in the desert. This is a totally peer military that has a military-industrial complex that is spooled up for a long-term war, has already been spooled up and continues to spool up. And we're just sitting here, and there's no plan. And as you get into these elections, the foreign policy chops of the Biden administration are going to be, Afghanistan, the withdrawal from Afghanistan is going to be brought up again. This debacle is going to be brought up. And not only that, you're starting to see more and more center-right and right-wing parties gain traction in Europe. People have had enough, not just of this, but the entire globalist project. And so that's my commentary on this. I think it's not actionable, but you can see what's going. And I think this is a good thing, because I'm totally against globalism. I'm totally against these people. They're all evil. They're all neo-Marxists. They all want to control you. They don't believe, they spout these things that they supposedly believe in. They don't believe in them. They're all beholden to outside actors, and they're disgusting people. And I hate them. I hate them very much. And, the people of the West are going to have to wake up, and you're going to have to you have to go in and literally, this particular puke over here, you see what's happening in his country. And what's he do? He sicks the state on the people. Okay, doesn't come down, doesn't address anything. I mean, this puke over here is trying to destroy family farms. His government finally fell. I mean, you're going to have to do what you have to show action. You're going to have to get in the streets like those Dutch farmers did with the tractors, like the Canadian truckers. And I know a lot of people don't agree with this, okay? But I'm telling you, that's what it's going to take. It's probably going to take worse than that. So We'll see. That because what I think is going to happen or what I suggest to you might happen doesn't mean I want it to happen. Doesn't mean I have some relishment that we're going to have a lot of conflict and social upheaval. No, I'm not for that. But these people helped create that. Okay, they are the creation. They are the ones that created all that. And why did they do it? That's the question you should ask yourself. For what? So anyway, that's it for this week. Thank you for your viewership, and we'll talk to you next week.